Hey everyone, it's Gerald here. In this video, I'm going to do a deep dive onto PayPal's most recent earnings that caused the stock to collapse over 30%, even on what seemed to be offering extreme deep value for the company, offering an even bigger potential discount here. I'm going to go over some of the revisions that I might be having for the company here, my expectations for the stock going forward, and a lot of the lowlights and even the highlights of PayPal earnings here. I'm also going to be going over the SaaS apocalypse here. So going over companies such as Adobe's, your ServiceNows, your Salesforce, going a lot of the technicals as well as the fundamentals. Is AI disrupting a lot of these core features of what these SaaS products are offering, or is Wall Street being overly cautious? I'm also going to be doing a deep dive onto HIMSS and Novo drama here. HIMSS, of course, most recently offering a generic version of Novo's Wegovy pill, now the involvement of the Department of Justice as well as the FDA here. So first and foremost, let's take a look into PayPal's daily time frame here on the technicals. So of course, the stock already on oversold levels at 26 after earnings plunged to an RSI of 12.84. Now the stock's sitting at around $40, seem to have stabilized around this area here. Of course, huge volume coming in during these times here. You're having a mixture of sell-offs as well as accumulations at this big area here. In terms of the RSI for the stock, this is the lowest the stock has gone on the RSI in the history on the daily time frame here. As you can see here, and I zoom back all the way since inception, the stock has never, ever gotten this oversold. We're talking about in 2018, we're talking about since 2022 during COVID. This is by far a historical move for PayPal stock. And I'm gonna go over whether a lot of the moves are justified or not here. So looking at the company's fundamentals, we're gonna go take a look at the bull case, the bear case, and the valuation metrics. So a lot of the deep fundamentals that I like to look at here. So looking at PayPal, the stock is obviously priced for disaster, right? Now the stock is trading at a PE of 7 with an enterprise value to EBITDA of 5.3. Objectively, this is cheaper than most traditional banks and implies that market sees no future growth for this company for the foreseeable future. Running a reversed DCF model for this company here, the market's essentially pricing in substantial negative growth for this company here. This might be an overreaction given the company's massive scale as well as their cash flow here. Looking at the bull case here, they are obviously a cash flow powerhouse. This is a free cash flowing machine here. So they are offering $5.56 billion in free cash flow over the last year. They just recently offered a new dividend of roughly around 1%. And of course, they have been aggressively buying back their shares, of which 1.5 billion in Q4 alone, right? So this should create a floor for shareholders, right? So of course, what seemed to be the floor of around $50 plunged even past that, and which I believe is likely an overreaction for the stock price here. Number 3, they are still a payments giant. They still hold a 45% market share in online payments. They have 220 million active accounts and overall a globally recognized brand. Any layperson out there probably knows what PayPal is and what they offer, right? So with that scale is that durable asset that they have. And of course, they have new leadership. And to many people, this can be seen as a pro as well as a con here. The appointment of Enrique Lores, he is known for cost discipline and turnarounds at HP. So overall, what's the main reason Alex Chriss was booted out was because they felt like Alex Chriss wasn't moving to the pace that the company wanted to. So whether it's reducing headcount, which he is known for, that's going to be able to really streamline a lot of operations, improve their margins, and offer a profitable segment. Of course, I'm going to go over why this might be a con for this, and this is why it's a bear case for some people here. So in terms of the bear case here, growth has definitely stalled for the company. Revenue growth has decelerated for 3 consecutive quarters, from 8% to 7% to now even 4% here. But understand, the market now is pricing in negative growth for this company when the company is still growing in low single digits here. Guidance now calling for a decline in earnings, however, for 2026. This is likely a sandbagged number for it, right? Running a lot of the numbers in terms of the free cash flow, what the company is offering, they are likely offering a sandbagged guidance so that essentially leadership can surpass it and grow from that standpoint. But of course, the stock and the sentiment is going to take a huge hit, at least for the short term, especially now since there's a lot of unknowns for the company, right? Where exactly, what's the exact strategy that Enrico Lores is going to do? Of course, we know that he is known for cost discipline and overall streamlining a lot of the operations, and where likely reducing headcount is likely going to be the case here. I think PayPal employs over 24,000 employees. XYZ, or Square, as a lot of people know it, operates with even half of what they're doing, and now they're even laying off people over at XYZ here. While yes, likely he's going to reduce the headcount, no one knows for sure until he says so, or there's a strategy in place for that, right? So, of course, that lack of guidance is going to affect the stock for the short term here. In terms of the core branded checkout, the main revenue source for the company here, though that has been under pressure, and it's been a hard metric for the company to grow, and that's going to be the huge challenge for Enrico Lores for the time being here. Key metrics like transactions per active account fell 5% as well. And then in terms of the bear case, there's execution and credibility crisis. The recent earnings miss and guidance cut triggered a 20%, 30% plunge, and ultimately was because of the CEO change, right? Because there's a lack of clear strategy for the company here, a lot of investors are scurrying away. Right. Of course, they're also with intense competitive moat erosion here. So PayPal's dominance is being chipped away and eroded by competitors such as Apple Pay, Google Pay, Stripe, and other forms of payments like Shopify's Shop Pay here. So they're losing some relevance. But like I said, is it enough to justify this sell-off here, right? Especially where it's pricing in negative growth for the company. I'm going to go a little bit more into that here. And of course, there's been a lack of insider confidence, right? Sitting at such low valuations, you would expect management to buy back their shares, right? Of course, they are rewarding that in terms of shareholders, in terms of the buyback programs, but a lack of insider buys and instilling confidence to a lot of investors is going to erode away at confidence for retail investors here. Looking at the business quality, it is mixed, right? PayPal's a tale of two companies. This is a legacy cash-generating titan now with foreseeable slowing growth, competitive encroachment, and significant execution missteps here. Profitability, the company is a cash-flowing machine, right? They have a fortress balance sheet. That's allowing them to fund a lot of buybacks and even institute a new dividend for the company here. In terms of the return on capital here, the return on equity is excellent. They have a 25.8% return on equity with a debt to equity ratio of 0.49 here, right? So they're not at a place where they're on high leverage for this company here. And looking at the company's moat here, that's definitely under direct assault here. So its primary advantage has been its massive network effects and the brand recognition. But while it's been durable, it has been noticeably eroding, right? So you have the emergence and even the growth of the Apples, the Google Pays, the Stripes, the Adyen, pretty much all coming into play here. In terms of the earnings consistency, it's been on a decline. That's what's caused the stock, in terms of the lack of predictable growth for the company, to be derated so significantly, right? But as of prior management with Alex Chris, there were a lot of different levers that the company was going to operate off of. And you even have Mark Greether with the ads business offering positive insights into the company, but no direct numbers have been shown to a lot of investors so far, which I thought there was going to be more clarity going into that earnings, right? It's been about, I don't know, 1 to 1.5 to 2 years for this ads business, and there's still been no tangible results in terms of the ads business. So that is something I wanted to see, but wasn't able to pretty much find through the management report here. Looking at management quality, of course, it is concerning, right? There's a lot of mystery. There's a lot of unknowns with new management, right? So the abrupt transition from CEO Alex Chris to now Enrico Lores is now going to be a huge question mark for the company here, right? You know that with his prior company, he is known for a lot of cost cutting. So you would expect that for the company. And through what's been offered in terms of information for a lot of investors right now, they want to move at a much faster pace. So we'll see once management or Enrico Lores pretty much takes the helm in March to see what he has to say. But right now, there's a lot of question marks for the company here. However, looking at the valuations for this company here, This company is trading at an intrinsic value of $91.60. So it's offering over a 50+% margin of safety here. Of course, a lot of discounted cash flow models are probably going to be re-rated. So you're going to get anywhere prices between maybe even 70 to even 90, but still offering a pretty significant margin of safety from a valuation standpoint, right? This is a PE ratio of 7 with an earnings yield of 14.2%, right? This is typically associated with stagnant or dying business, not one that is generating over $5 billion in annual free cash flow. With $5 billion in free cash flow, it's going to offer a lot of lever, especially with newer management, to inspire growth for the company here. Of course, they need to execute, right? But having $5 billion in annual cash flow is going to offer a lot of different levers or ways to maneuver to incite growth for the company here. So I think as a long-term holder, a lot of longer-term holders are going to be A-OK from that standpoint, considering such a cash-flowing machine the company is currently at. Wall Street, of course, has been mixed, right? You're getting a lot of downgrades in terms of Wall Street as of the most recent earnings or even leading up into the earnings. But overall, the average analyst price target is still sitting roughly around $80, right? Of course, now you're probably going to get a lot of revisions in terms of the price targets, most likely towards the 50s, 60s to 70s. I don't think majority of people are going to have the price target of $80, but it's still offering a decent margin of safety here. In terms of the risk and headwinds, it's obvious. The company is not without its risks here. There's risks of a failed turnaround execution. That biggest risk comes with the new CEO, Enrique Lores, with his failure. If he was not able to reignite growth for the company, improve the margins for the company, or stem a lot of the market share losses that's been going on with the company in terms of Apple Pay, Google Pay, and everything that we pretty much talked about before here. Of course, I do think margins are going to likely be improved. I think growth is going to be able to be flatlined or even slightly grow from here. Market right now is obviously pricing in the most pessimistic scenario here. So I think it's offering a decent margin of safety from that standpoint here. Number two is accelerating competitive losses, right? Apple Pay, embedded finance, direct bank payments are going to continue eroding into PayPal's market share. So the main challenge is essentially maintaining a lot of that market share. Of course, and there's the consumer spending slowdown, right? PayPal's exposed to a macroeconomic weakness. If there's any macroeconomic weakness in terms of, hey, there's a recession, transaction volumes are going to decrease, revenue is going to be hard to keep up, and that's going to affect PayPal's bottom line and top line there. So overall, the bottom line is this is a potential argument between a value versus value trap here. This is a still financially powerful company with a still valuable network that they are going to essentially leverage, right, in terms of their ads business that is still yet to fully come into fruition here, potentially offering a fire sale price, right? Due to those, they are legitimate concerns with growth, competition, and management credibility here. So offering this margin of safety here, I'm going to be looking at potential areas where I'll be salvaging this position as well as accumulating where I'm currently at here. So obviously RSI is currently very oversold at $14, seems to have established a footing around this psychological $40 here. Might be a dead cat bounce somewhere time in the future. I'm looking at a Fibonacci retracement, potentially 50%. That's going to offer somewhere towards $47 here. From this standpoint here, I hold a significant amount of shares into PayPal stock here. I'll be looking to run covered calls into this position. But like I said, I don't have much confidence in the stock to make a major rebound in the stock here. So I'm running those covered calls to essentially lower my cost basis into these areas. Ultimately, I do think it's going to have a rebound or gap fill back towards the 52 area and 56, even $60 areas. And that's where I'll essentially look to potentially exit my position here. The thesis is not the same as previously. Part of me being an investor with PayPal was through management with Alex Chris here. I did believe in his execution, though slower than what I wanted and as well as what management wanted. A lot of the numbers were inflecting towards the right way. Right. So we'll see with what new management has to say. I do likely think that with new management and some news about potential reduction in headcount, that's likely going to offer a sizable increase in PayPal shares here. Of course, valuations down here. It's already a lot of speculation about potential acquisitions for PayPal, potentially even Elon Musk here. I think it's being priced at less than what X was previously valued at. He wanted X to be a payments platform, an all-in-one payments platform. PayPal is going to provide a lot of those rails and the infrastructure for that at a really reduced price tier. So it wouldn't surprise me if you probably hear some news about some activist investor or a potential even an acquisition at these prices, fire sale prices down here. Next, I'm going to go over Adobe stock here. Right. So I'm gonna go over the bull case, the bear case for this company, a lot of the technicals and a lot of the fundamentals that I like to look at for Adobe stock here. The bull case for Adobe stock is quite simple here. Over 1/3 of Adobe's annual recurring revenue, the ARR, is now AI influenced, and consumption of its generative AI credits tripled in the last quarter here. So growth is present for this company and much more so. So I'm going to go take a deep dive into the valuations. If the PE ratios now trading at historical lows makes sense for a company that's growing at double digits here. So, and like I said, they are consistently offering double-digit growth, right? The revenue growth for this company and how the company makes its money through its subscription service is, quite frankly, very predictable, which is, and companies essentially guiding for double-digit revenue growth here. So the company's delivered revenue growth of 10 to 11% for the 3 consecutive years, and ultimately culminating in a record $23.77 billion in fall of 2025 here. Right, so this is exceptional profitable company with 90% growth margins, and they have a great financials. Right, they have an interest coverage ratio of 33x times and a manageable debt to equity of 0.53. So their balance sheet is also rock solid, as I previously gone over with even PayPal stock. And this is also a buyback machine. They repurchased 30.8 million shares in fall of 2025. So that's going to essentially create always ever demand for the company here and a floor for the company here. I'll go over why with the technicals of the stock trading at such low valuations there. Guidance also signaled confidence, right? Management called for revenue growth of 25.9 to 26.1 billion in earnings per share of 23.3 to 23.5, right? So significant 12% upside to previous analyst expectations. Obviously, there's a lot of cons with the SaaS apocalypse here. The bear case is the company's been going over a lot of technical weaknesses, and right now there's an active valuation compression with a lot of these SaaS companies here. So the company once trading at a PE of over 50 to now literally just 15.5 in a market where a lot of stocks are trading 30 plus, right? They're also with rising cost and margin pressure, right? With the AI coming into play, that's going to erode at their margins, as well as going over the AI moat question that's been going on here, right? So the core thesis remains, does Adobe hold a durable competitive advantage with other people here? And to my knowledge and understanding, a lot of AI or a lot of Adobe's revenue sources come from enterprises, right? So being in an enterprise company, the switching costs are extremely high, and a lot of people are even asking, is Adobe even offering even AI services? They are actually going into that, right? I like to compare this a lot with Google, what was happening with Google at one time, right? There was a time where Google's Gemini was saying they were losing massive market share. AI was going to destroy Google. They were losing it to Apple. They were losing it to NVIDIA, and AMD, and so forth, right? As you can see, Gemini was an AI service. And that's the same sort of situation that's been going on with Adobe stock, with its Firefly and so forth, right? And it's offering a significant growth for the company here, not to the level that Wall Street wants in terms of how much to bring in terms of profitability, right? But like I said, these things take time to scale. And a lot of people fail to sort of see the fact that they are instituting AI to help them grow their company rather than just sit down lying and let AI destroy their company. I'm not going to go too much into the profitability. Like I said, we already went over a lot of their manageable debt and debt to equity ratio. They have excellent return on equity, of course. I want to take a deep dive more into their valuations here. So looking at their intrinsic value, it's sitting roughly around 434. So offering about a 40% discount to current valuations here. Of course, there's many risks and there's many headwinds for this company here. There's the AI disruption risk, right? Adobe's core creative software moat is being eroded by AI, and a lot of question is, are people going to transition to another from one AI service to another here? They're also with failed growth investment. The planned 1.4 billion increase in ad spend is going to be a significant bet for this company right here. So that could weigh on a lot of margins for the company. So we'll have to see with the upcoming earnings, how the numbers are going to be looking like with this increase in ad spend, right? And that's the question that the overall market's having, right? In this market, you need to spend right? The ones who are being left behind are the ones who are not spending. So I don't see this as a huge risk for the company here, but it is a unknown whether these significant investments are going to provide a tangible, substantial growth for a lot of these companies here. And because of that uncertainty with the AI, with the potential increase in a lot of spend for these companies here, that's caused a sector-wide derating for these, right? So you have ServiceNow reporting excellent earnings in terms of growth. Same thing with CRM. That's just how the market is essentially trading here. Bottom line for Adobe, this is a world-class business with consistent double-digit growth, phenomenal profitability, and a strategic lead in generative AI, not just laying by and not utilizing AI. For me, I'm looking at this as a potential buy opportunity. Of course, you have IGV, which is the ETF that tracks the software tech space, trading in greatly oversold levels here. We just have a huge volume, massive volume for the past couple of days here, and it seems to have been stabilizing roughly around this $80 level for IGV here. Looking at Adobe specifically on the daily time frame here, greatly oversold, offering a potential RSI divergence from here. We have earnings coming up on March 12th, so still rough weeks away for this company, so we can find more better numbers here. But the company, as what is shown right now, and in terms of the risk management, the downside risk for the stock, I believe is fairly limited, considering its valuations and the growth that it's offering for a lot of investors here. Lastly, I'm going to go over HIMS and the drama that's been going on with Novo Nordisk here. So looking at HIMS on the daily time frame, like I said, majority of the market, a lot of technicals are not even being respected in terms of how oversold stocks are. The oversold is getting even more oversold, right? So you're still trying to establish a footing or a bottom for a lot of these stocks, right? Where there's obviously bearish sentiment and bearish momentum in a lot of these stocks. And as of the most, in the after hours on Friday, offered even bigger drop, over a 8-10% drop. I think the stock is sitting at $20 now after the most recent news of the Department of Justice pretty much and the FDA hounding at HIMS or directly mentioning HIMS as a company that they're going to be pursuing because of their false advertisements with Novo's Wegovy pill here. My opinions on that whole ordeal, I don't like the fact that HIMS management proved an advertisement where they outwardly said same ingredient as Wegovy. While yes, you can advertise that you're offering a generic version of whatnot, but by mentioning Wegovy in and of itself, it has implications along with it, such as it's offering for weight loss or is having some same level of efficacy as Novo's Wegovy pill here. There's a lot of uncertainty in terms of, hey, does a generic version, which doesn't offer the SNAC protocol that Envo has patented, is going to offer that same level of absorption. So likely they're going to need even more higher milligrams or higher dosage of the generic version, semaglutide, to pretty much offer the same level of efficacy or even provide any efficacy for that matter. So that's that question mark of whether HIMS is literally just looking for profits versus looking out for what they're saying for the safety of their consumers and the subscribers, essentially, right? That is a huge question mark for HIMS as a company. Of course, they are being a big disruptor in the industry. And when you try to disrupt a billion-dollar industry, a multi-billion-dollar industry, if not trillion, I don't even know, you're going to be met with a lot of resistance. And by fighting against Novo, top pharmaceutical companies like Eli Lilly, there's going to be lawsuits involved here. So that's going to be a huge overhang and huge headwind for HIMS stock. For me, it's not a stock I personally want to touch. There's going to be a lot of volatility around this time. Wegovy's pill or their weight loss, GLP-1, in terms of how much revenue it produces for HIMS, is roughly around 30%. So losing potentially 30% of their revenue source is going to be massive for the company here. Of course, this might be offering a substantial generational buy for a lot of investors here. This is a company that has the potential to disrupt the industry, right? And they're doing a great job. There's been a lot of advertisements, a lot of free press because of all of this. But sometimes that press might not be too good, right? And that might be eroding a lot of HIMS brand value if investors start to seeing it as in, hey, this is a company that really doesn't care for the safety of their patients and rather just offering a sugar pill, as some people may call it, right? So there's a lot of trials and testing that needs to be done before you can even advertise something like this. Of course, I don't think Hims management would be so bold as to release an advertisement stating that this is the same ingredient as Wegovy if they haven't done extensive research onto it, right? But you never really know. And that's the main difference here. And then you have most recently, I think there's a recent headline with Hims that they are going to withdraw their generic version for the time being. So, yes, that's a good thing. They might not be in the same sort of scrutiny or same oversight with the FDA and the Department of Justice because they stopped something like this, but you never know. Right, that's the uncertainty there in valuations sitting or on a higher price to earnings. It's not a level of comfort I like to be in, especially with a substantial position here. I try to look for positions with extreme low risk with higher upside, and Hims offers more of a high risk, high reward sentiment or sort of setup, although it's trading at very oversold levels. Valuation wise, they're innovating constantly with its whole peptides, all the different levers, their expansions worldwide as well. So there's a lot of levers that the company can still go through. Established a very good brand for themselves, so they have a lot of runway to grow from that standpoint. They are projecting substantial growth for the company here, sitting at only potentially just a PE ratio of 30, offering double-digit growth for the company. That might be presenting a lot of potential value for a lot of investors here. So that is my take on PayPal, the whole SaaS apocalypse, Hims. Yeah, let me know what your thoughts are, whether you agree with my thoughts as well. And as always, happy trading, guys. You guys have any other stocks you want me to sort of investigate and do a deep dive on? Go ahead and leave a comment down below. Hit a like button, and as always, subscribe here.